Welcome to all of you who've just joined us, and welcome back to the rest. Welcome to all of you who are joining us online in the live stream. We are back. Again, I'm Raj Kumar, President and Editor-in-Chief of Devex. Delighted to be with you here in London to talk about the future of development finance. And we've got a really important one-on-one interview with the CEO of the CDC Group, Nick O'Donohoe. CDC is one of the world's largest and a pioneering DFI. And we are going to talk a little bit more about what's in the future for CDC and what's in the future for development finance more broadly in a little one-on-one discussion here. And so Nick, I want to get your take, first of all, on the current status of development finance, because we're very optimistic in our agenda today here at this Devex event, and we're talking about billions to trillions. Where are we actually today? What do you see being on the front lines of this?
So good morning, everybody. It's a pleasure to be here. Thank you, Raj, for inviting me. So look, I think this is an extraordinarily exciting time to be in development finance. And I suppose there's never been a time, if you look at the big picture, there's never been a time where what we do, investing in private companies to stimulate economic growth and create jobs, where that's been so front and center in the development agenda. And that's a function, I think, of the SDGs. It's a function of the Addis Financing Conference. It's a function of the climate emergency. And it's all focused, as we heard in the last session, it's all focused attention on the critical role that the private sector plays and the critical need to get capital to the private sector in some of the most difficult, poorest countries in the world. So from that perspective, it's a great time to be in development finance. And that's also manifested when you look at the various donor governments around the world who are all, almost without exception, increasing the capital that they're giving to their development
in your case in particular, CDC's budget is growing.
Yeah, and so we're big beneficiaries of that. And CDC has moved from an investment or commitment rate. Well, it's moved from, frankly, in 2012, just being a fund of funds, an emerging markets fund of funds. Over the last 6 or 7 years, it's moved to an organization that's obviously an active investor directly in debt, directly in equity, as well as continuing to be a large fund of funds. Our investment rate, our commitment rates increased from a run rate of around $1 billion a year a couple of years ago to something over $2 billion today. Our headcount has increased from 50 people in 2012, when we were just this fund of funds, to almost 400 people today. So that's all, I think, a reflection of the support and ambition that we have from DFID, our shareholder, and it's also, as I said, a representation of the need for development finance today.
And you're out there; these hundreds of people are out there scouring the world, looking for deals they can invest in. And what are they seeing when they're out there in the markets?
Well, the first thing is, as many of you know, we don't scour the world. One of the things that DFID did in 2012, which I think was very sensible, was to say that they wanted CDC focused on just a couple of important regions, and those are the regions that had the largest number of people in need. So we have focused since 2012 on our investments solely on Africa, principally sub-Saharan Africa, so almost everything, and we have an incentive process that incentivizes us to invest in sub-Saharan Africa. And secondly, South Asia, and South Asia means India and the neighboring countries of Pakistan, Bangladesh, Nepal, Myanmar. So we're not scouring the world.
Well,
so we're just scouring.
It's a big portion of the world. You've got your work still cut out for you.
It's a big portion of our, I suppose, development finance world. And yeah, so they're out trying to find private companies, and we invest only in private companies. So we don't do, unlike some of the other larger multilaterals and so on, we don't do any lending to governments. We don't invest in state-owned enterprises. We scour our regions of our geographic regions, looking for companies, looking for entrepreneurs, looking for sponsors who we can partner with to build businesses that will improve the conditions of the people living in those countries. So we have a focus on a core number of sectors: infrastructure, financial institutions, health, education, agriculture, real estate, manufacturing, and basically focus on those sectors and try to, as I say, identify partners either directly or through funds that will in turn identify investments.
And the sort of chicken and egg question, do you find when you're out there looking at these deals that there are just more deals than you can possibly fund, and that the money, for whatever reason, is staying in London or in New York, and not flowing, or is it that the deals aren't there, they're not at the markets aren't advanced enough for the funding to come?
So let me contrast the two regions that we invest in, because I think there's a very distinct difference between the two. If we look at a third of our portfolio is still in India. If we look at India, you're looking at a country that has still got 350 million people living below the poverty line, still has enormous variation from state to state and city to city in terms of wealth. But at the same time, at the top level, has a significant amount of capital inflow coming into the country. So that is sort of one example. On the other hand, if you look at Africa, you're looking at something very different. And one of the things we were talking about before we came out, but if you come to a conference like this, and you listen to sort of the rhetoric around investing behind the SDGs, the rhetoric around blended finance, the rhetoric around impact investment, and you look at the region in the world that clearly has the most significant development needs, namely Africa and sub-Saharan Africa, you would naturally expect that the amount of money and capital flowing to Africa was going up. And if that's what your expectation was, you would be wrong. Because the amount of capital, if we look back over the last 4 or 5 years, that's been going to Africa from commercial investors has been going down. And there's a couple of reasons for that. One is that the banking sector is subject to much more stringent capital requirements today, which makes, from a capital perspective, Africa a much more expensive, riskier, more expensive place to put capital. The cost of compliance and the regulatory compliance have gone up everywhere, and they're probably more difficult to manage in Africa. So the result is, if you look at the top 10 or 12 international banks, they're all pulling capital. They're all pulling capital, closing offices, and so on in the region. And if you look at the other important provider of capital, private equity, you'll see that the amount of money flowing into African private equity funds, and CDC is the largest investor in private equity in Africa. We are a partner in 70 different funds. And if you look at that market, you'll find that the amount of money flowing into African private equities declined by 50%. And if you talk, and there's probably some people in this room who are in that business, but if you talk to anybody trying to raise funds today, they'll tell you it's next to impossible.
And is this because the returns are bad? I mean, is it?
Yeah.
Because you'd think if money were to be made in these markets, you would see more money flowing.
Of course. I think, look, this gets back to our question on impact investment and so on. I mean, the brutal reality is that need does not mobilize capital. And we might, in this room, love if that were the case, but it's not the case. Opportunity mobilizes capital. And so when people look at Africa today, what they see is certainly over the last, since the commodity cycle turned, 5 years or so ago, returns have been difficult. And currencies have been weak. There is an increasing problem in many African countries with debt and over-indebtedness at the sort of government level. So all of these things are, for commercial investors, when they look at them, these are things that are going to put them off, and they do put them off.
And do commercial investors, in your view, look at Africa in that way as Africa? I mean, it's a big, diverse continent with many countries, many different economies and local contextual factors, but is it still seen as one big market from the commercial standpoint?
Yeah, we always say, I think that's a really good question. I mean, we always say that Africa, of course, is 54 different countries, and we shouldn't, and we do tend to talk about it as one continent. I mean, I think if you talk about commercial investment, South Africa has always found it much easier to attract commercial investment. That's still the case today. I think North Africa, certain countries in North Africa are finding it somewhat easier to attract capital. The sub-Saharan Africa is still finding it increasingly difficult. But also, from our perspective, as you said, we're out there looking in Africa for the opportunity to invest in private sector companies, the opportunity to help provide affordable, accessible goods and services to improve the lives of poorer people. And so when you look at that, you do see a real bifurcation among some of the countries in sub-Saharan Africa. You've got countries like potentially Ethiopia, Rwanda, Ghana, who are following who have governments that are trying to follow, and they all have their issues, but they're trying to follow more responsible economic policy, more responsible macroeconomic policy. And importantly, they're really trying to enable the private sector rather than get in the way of the private sector. And then you go to other countries where that's simply not the case, and where you still have the problems, all the old problems of sort of irresponsible macroeconomic policy, poor governance that have really been a barrier to progress in many of these countries for many years.
Now, before you took on this role, one of the roles you had was advising the Gates Foundation on blended finance. Yeah. The blended finance market has grown. It's about $50 billion now. But as we think about getting to trillions, this seems to be the place where you would have that opportunity, right, to encourage private capital, which has the trillions, by making it less risky. What is the challenge around blended finance?
So I think, look, the first thing I would say is I think what's happened in the sort of rise of blended finance over the last sort of 3, 4, 5 years has been a very good thing. And I know Chris is in the room from Convergence, for example. I mean, the work that organizations like Convergence have done in terms of trying to drive and develop that has been, I think, very, very important. But I suppose what I learned at the Gates Foundation was it's difficult stuff. It's really, I mean, what you're trying to do, if it's pure blended finance, you're trying to bring two different actors with different risk and return and impact objectives together into one vehicle. And that's just a really difficult thing to sort of arbitrate. So what you end up with a lot of the time with is a lot of complexity. You end up with a lot of concern around subsidy and where that subsidy is going. And these things have tended, I think, in some cases to delay or get in the way of taking advantage of the blended finance opportunity. I also think there are certain types of transactions that lend themselves to blended finance, and particularly those which have predictable cash flows. So if you've got, some infrastructure projects where you've got sort of government offtake agreements, so you have predictable cash flows. Some large SME lending portfolios where you've got sort of predictable loss ratios. I think those type of things, it's much easier to try to put together a capital structure and plug in a sort of a concessionary or piece into that and make it work. But when you get out of that and into some of the riskier areas, some of the technology investments we were talking about before, health, education, agriculture, I think it starts to get very difficult. But I don't want to be seen to be talking down blended finance, because I do think it has made a big contribution and will continue to do it. Now, whether or not, I think the billions to trillions sort of rhetoric, whether we...
You don't see these trillions coming.
Look, I think, I said before, I think that need, much as we'd like it to, does not mobilize capital. Opportunity mobilizes capital. So what will mobilize large amounts of capital into, say, Africa are responsible macroeconomic policies that lead to stable currencies and low interest rates and low inflation rates, good governance, which is a chronic problem, and an ever-increasing better technology, better infrastructure, an increasing amount of human capital. These are the local capital markets that can also provide funding alongside development finance institutions. These are the things that investors will look at and see opportunity from and follow.
I mean, need and opportunity can be defined in different ways, right? And in a sense, like thinking about CDC, the way in the past you defined opportunity was around job creation, those kinds of impact metrics. Isn't there an opportunity to look forward and say we can change the way we measure and therefore prioritize development outcomes, health outcomes, education outcomes that would then drive the money into these spaces? How do you see the measurement opportunity?
Well, I think measurement, and I know in the next panel you're going to be talking in more detail about measurement. It's obviously a huge issue for development finance institutions, and I suppose looking at the history of DFIs, I think there's almost been a complacency around measurement in the DFI community, in the sense that the organization sort of sat there and said, well, we're DFIs, we're interested in development, so as long as we're doing responsible investment in poor countries, that's job done.
And you're generating return, and you're maybe creating jobs.
And you generate a return, and you can point to job creation and so on. And I think to some extent, and I don't want to preempt the next session, but I think the measurement agenda has been driven more by the impact investment community, where they don't have that initial credibility because they're red-blooded commercial investment firms. So if you're TPG or Actis or whoever, they've had to be more thoughtful, I think, about thinking more broadly about impact. At CDC, we made a very specific commitment to DFID when we entered the current what we call 5-year strategy, which began in 2017. We made a very specific commitment to be more rigorous and more sophisticated about the way we thought about impact and the development impact we were creating. And that's not to say that what we were doing before, which is very focused on It was very focused on the countries that we were investing in and making sure we were going really to the fragile and conflict states. And it was very focused on job creation. And job creation in some sectors, like manufacturing, for example, does tell the story in a very powerful way. But then in other sectors, infrastructure, financial institutions, health, education, it's not, the development outcomes are not just about the jobs you create. That's a part of a much broader story. So we're trying to get much more, as I say, rigorous about we've implemented the impact management project, which you'll hear Clara talk about in the next session as a way of trying to bring discipline to our thought process about who's benefiting from our investments and how much they're benefiting and what are the risks that they won't benefit. And we've got much more rigorous around individual sectors, so being more precise about choosing metrics that are sector specific. We're trying to become much more sophisticated about baselining, so when we go into an investment, what actually happens along these metrics over the period of time that we are an owner of the company or an investor in the company. So it is, but that's, I mean, if you talk to our shareholder at DIFA, they will tell you that CDC's license to operate depends on its ability to tell its story from a development perspective, because otherwise, why else would the UK taxpayer be funding us?
Yeah. Now, as we wrap up the discussion, you've given us some harsh realities, which is good. We need to hear those. That's why we're here, to think about the challenges ahead of us. And I haven't even gotten into the point about the global recession that might be coming soon and what that will mean for these markets that are already in a bit of a downturn. But give us your sense, we're only 10 years out from 2030. We've talked a bit about disruption in the connectivity space. Thinking more broadly, do you see disruption coming in the development finance space? Is there a chance, you've sort of poured a little cold water on the trillions concept. Yeah. What do you think? Are we going to be able to find a way forward? And what is this going to look like? If you put out your crystal ball, what does this look like heading toward 2030?
Yeah, I don't want to appear obviously overly negative. I mean, obviously what we do, what everybody in this room is involved in providing much needed capital to these countries, and is critically needed, and I think it will make a big difference over the next 10 years. The technology, the connectivity question, which the last panel addressed, is a really important one. I mean, and you see when you go, again, I'll use India as an example because we have invested there over the last 30 years. I mean, India has become a country that it's still got 350 million people living below the poverty line. It's still got lots of very poor states. But it is a country that is being transformed by the availability of capital. And a big driver of that has been the technology revolution and the fact that they have better broadband access today than they did, and everybody's got a phone and so on. So I think, and that is still taking root, some of that in Africa. We invested $180 million in a company called Liquid Telecom about 6 months ago to help them build a fiber broadband network across Africa, because we think that's a really important enabler. So I think, and some of the other things that have happened in India, I would describe as the plumbing, the way the personal IDs, the fingerprint IDs, having a functioning credit bureau. I mean, these are also things that are enabling companies to penetrate much deeper into the sort of bottom of the pyramid. And I think that is also, if you believe that the private sector is a key to a real significant leap forward in development, then I think one should take that great encouragement from that.
Well, this is a lot of where the action is, which is why we wanted to have you on stage today and have this session. Devex has just published a special report. We'll tweet it out in a second if you haven't seen it. But it's a really in-depth look at DFIs. Because in general, the DFI space is probably underreported on, maybe understood, given its importance and its growing role, as you talked about the budget at CDC growing. So I want to thank you for helping us with a reality check, which we needed to hear, and a sense of what you're doing at CDC. It's important work. Thank you.
Thank you, Raj. Thank you, everybody.